Good evening, everybody. Sorry for the delay. We have Rob Roy join us this evening, and he is going to explain his unique strategy for finding stocks that are in a specific pattern and poised for a volatile move. So without too much more, Rob, welcome.
Thanks, Becky. You were about to say without further ado, right? We've already had further, though. So how much further do we go?
I got choked up.
I heard you trying to figure out, well, what's the appropriate words to use here? All right. Thank you. I appreciate that, everybody. I apologize for the delay getting started. I'm a PC guy. I've got a really cool presentation for you, but it's made in QuickTime Mac product. My support staff likes to fool around and create these real elaborate presentations, and for some reason, the QuickTime is not chatting real well with my PC tonight, so we're going to go through the old-fashioned Windows Media Player. So apologize for that, but you'll still get the gist of the presentation, and I think you'll there are all kinds of technical issues. I promise this will be worth it to you. If you haven't seen this presentation before, I assure you that by the end of the presentation, you're going to think, wow, that's pretty cool. I've never seen that before. And that's how I want to preface this, is I've been trading options for nearly 20 years. I'll give you a little bit of my background here in a few minutes. And there's very few things that are proprietary in the world of trading options in this day and age. They've been around for so long now. But I do think this is unique, and until somebody comes forward and says, oh, I saw that 10 years ago or whatever, I'm going to continue to call this proprietary. And actually, I've got a great example for you of a position that we just closed that's a perfect illustration of how this works. So without further ado, as Becky said, let's go ahead and move on. We call these Axiom Strangles. I'm Rob Roy from Option Axiom, and so since nobody else has had this strategy before, to the best of my knowledge, we named it after us. And this is how we can profit without forecasting market direction. Isn't that the most difficult thing, is trying to figure out which direction the market's going to go. So what we're going to learn is how to profit without forecasting market direction. We're going to do a comparison between straddles and strangles. We're going to talk about the secrets of using deltas. If you're an options trader, you know you need to understand the Greeks, because everything boils down to the Greeks. And we take advantage of them. And that's the cool thing about this strategy, is it comes down to the math, the factual things that have to occur in the world of trading. And we just change things around a little bit to take advantage of the mathematical formulas that are fixed and finite. And we use them to work in our favor. They're originally kind of designed to work against us a little bit. You know, there's two sides of every trade, right? There's a buyer, there's a seller, and at the end there's a winner and a loser. It's a zero-sum game. So if somebody's winning, somebody's losing. And I'm a little bit of a conspiracy theorist, I admit that, but it seems that the game sometimes is set towards the floor traders. They have just a little bit of an advantage. And, you know, I hate to use this. No trader ever wants to compare this to trading to gambling, so forgive me for doing that. But if you go to Las Vegas and you walk into a casino and you look up at this monstrosity of a building, do you think that maybe the casino has some sort of an advantage? You know, people, they make bad decisions when they're gambling. They gamble too much, things like that. But in the end, they can't build those huge, massive buildings if they don't have an edge, because people are going to get lucky. There's sometimes, you know, people will win. So there has to be an advantage somewhere. In the world of trading, it's the floor traders, it's the market makers, it's the guys that pay all that money to be down on the floor. They have a slight edge, and the way they have an edge is due to the math. So what we've done is we've taken that little edge that the market makers have in the world of trading, and we flipped it around to where we can have that same edge. When I go into a casino, I might as well stay with a gambling theme since I opened up the door, right? When I go into a casino, there's only one game that I'll play, and that's craps, because craps is the one game that you have the same odds as the casino. So it's just a matter of skill and luck. There's no outside edge. I refuse to do anything else, because I don't want to walk into a situation where I know I'm already at a disadvantage. And it's the same thing here. We're going to utilize this math. We're going to utilize the Greeks to turn the advantage into onto our side. We'll talk about the patterns. That's very big as far as which patterns are going to move and how to find them early. The key to getting in, we do know that options are a decaying asset, right? Time decay is a big enemy in the world of trading assets, so the sooner we can get things to break out, the better, and we have some unique indicators that we utilize to help us get into the position a little bit earlier. This is the equity curve that we've been able to create since January of 2012, just simply using this one strategy. Option Axiom, we have several different strategies that we trade. Not the whole gamut. I don't believe in doing that. We have very few specific strategies that we utilize, but that's the equity curve just on this one specific strategy. So waiting for me to get the technical issues worked out and get to this, I think if you look at that, you think that, well, maybe this is worth a little bit more of my time and paying attention. I'm not going to spend much time on my background now since we've already gotten started late, but I used to be a golf professional. Right out of college, I lasted 10 months in the traditional world of having a job and working for somebody else, corporate America, as they call it, and I realized that I just can't do this my whole life. The thought of that was frightening to me. I was always pretty decent at playing golf, so I spent nearly 13 years as a golf professional. I was a club professional, not a tour player, and not that I didn't feel I had the ability to play the tour, it's just I really enjoyed teaching other people how to play the game. And when people say former golf pro, I mean, why would you ever leave that career? It's extremely time-consuming. If any of you are listening play golf, you know the busiest times at any golf course are weekends and holidays. So for nearly 13 years, if you can imagine this, I never had a weekend or a holiday off. And I may go into the golf shop and open it up at 7 in the morning and not leave till 11 at night if there was a function in the evening. And I love golf, and I love being around the members. I loved everything about it other than the amount of hours. And I was fortunate enough to be a golf professional at a private equity club, which meant I was in the upper echelon of salaries around the country. But still, when you started dividing the number of hours into what I was earning, I was like, wow, you know, the salary looks okay, but then when you divide it into how much time you're putting in, all of a sudden it doesn't look so well anymore. The only other thing that ever interested me was how money worked. So as I was I didn't want to be a golf professional for my whole life. I got a securities license, insurance license, mortgage license, went through all the training, did everything you need to do to become a traditional financial advisor. So I transitioned away from golf into the world of a financial advisor. That lasted less than 2 years because I was very dismayed in the traditional world of being a financial advisor. When I first left, I started work for another company, and here, you know, now I've got a boss, and I already had 12 years of being my own boss, so I was like, I can't do that. So I started my own financial services business, and it went really well. In fact, in the year 2000, I was in the Millennium edition of Who's Who, a Financial Advisor. So things were going well, had a good business, but it didn't feel right. You create these wonderful asset allocation plans, and you bring clients in, and you talk about spread your assets, and don't worry about what the market does. Well, I realized that no matter how great your asset allocation plan was, if the market went down, you still lost money. Maybe you didn't lose as much as you would have if you were all in on the stock market or whatever, but you were still losing money if the market went down. And I just remembered going through my securities training and realizing these option things and these puts, the options that allowed you to not only protect yourself from the downside, but make money if the market went down. So I educated myself on trading options, and then much to my dismay, broker-dealers, the people that you work for in the financial services business, not only didn't want you trading options for your clients, they didn't allow you to do it for yourself either. And I was like, that's crazy. You can tell me what I can't do this in my own account? And that's true, you couldn't. And I said, well, forget this. So I walked away, and I handed my entire book of business to a representative in my office, and I just started trading. And for a while, I just traded for a living. That's all I did. And then I started thinking, well, yeah, I would really like to teach other people how to do this. And I became an independent contractor and was fortunate to work with some of the top educational firms and literally traveled the world teaching others how to do this. And when I was traveling around, I started hearing the same type of thing I was hearing from a few of my financial advisory clients. There were a few people, you know, you build a relationship with, and when I left, they're like, why are you leaving? And I explained it to them. They said, well, I still want to know what you're doing. So I would send them emails and say, here's what I'm doing, and they were following along, and it was just a small group of some of the clients that I had. But when I was traveling around the world doing the educational seminars, I was hearing the exact same thing of, I just want to follow along with somebody else and follow along with what you're doing. And so after traveling the world for about 12 years, I decided that I was going to start Option Axiom. Too many people were saying the same type of thing. Felt like maybe I could be more of use instead of being just in seminar rooms and talking to 20 or 30 people, to have an opportunity for as many people as wanted to follow along. And that's how Option Axiom began and how I'm speaking from you, in front of you today. And I guess that wasn't really short after all, was it? Apologize for that. I'm going to assume that you have some basic knowledge of options. If you don't, it's okay, because we'll go through the real basics of what you need to know. I'm sure everybody's familiar with the long call. The uniqueness of a long call is it allows you to profit if the market goes to the upside, or the underlying stock that you're buying options on goes to the upside. We all know there's no limit to how high a stock can go. There's no limit to how much money you can make in a long call either. But the beauty here is you have limited downside. Whatever you paid for that call, that's the most money that you can lose. And with the leverage in options, you can put up a small amount and control large numbers of shares, which means if you're wrong, you only lose a small amount, but if you're right, then you have the exponential profit of the leverage involved in the option versus the stock. So options immediately, to me, were the exciting place to be, and this is what really got me, is the fact that here's a way that now we can profit if the underlying goes down, and that's a long put, making money if the underlying stock goes to the downside. Or now, the beauty of options now is there's so many different variables that are optionable. We just finished doing a web series on options on currencies and futures. It's amazing. If you go back and look at the statistics recently, the only area of the market that's growing is derivatives, options. Everything else has been shrinking down over time. This is the area that's growing, and the reason is we're getting past that whole options are risky stuff to where there's enough good education out there that people are starting to understand, hey, there's a way I can limit my risk, protect myself, but still use the leverage to generate more profits when I'm right. And that's what initially attracted me. So with a long put, you can make money as long as the stock goes down. It's not unlimited because there is a floor, right? There's some major support at zero. Stock can't go below zero. So I like to use the word substantial. We can make a substantial amount of money if the stock goes to the downside, and we still have that limited risk if it goes to the upside. So those are the two basic options, a call and a put. This is a risk graph. I'd imagine you're familiar with it. This is how we plot a visual picture of what's going on with an individual trade. The vertical axis is your profit loss. The dotted line represents the zero or break-even line. Anything above that is profit or potential gain. Anything below it is risk or potential loss. The horizontal axis down here is the share price, the stock price, or whatever the underlying asset is that you're trading options on. And you can visualize this bottom left corner as being zero and the upper right corner being infinity. Or the way most traders do it is they take a snapshot around the particular price level of what happens if the stock moves a bit up or a bit down from where we are at this point in time. So if we were to combine that long call and that long put, the things that we just covered, put them together, this is the risk graph, and this is what's known as a straddle. Now, a lot of people don't like straddles due to the fact that they have a bit higher cost. It's actually one of the most expensive option positions that you can put on. And we're trading options because we have the ability to put up less money, right? So now here's a strategy where you're putting up more money. If you look at the risk graph, the interesting part, though, is you can make money if the stock moves up. You can make money if the stock moves down. Those are the two green lines moving at a 45-degree angle to the upside, left and right. The V part, that's the risk. That's what's below the zero line. And the way we lose money in a straddle is if the stock doesn't move, because we are subject to that time decay that I recently mentioned. So as long as the stock moves, we have the opportunity to make money regardless of whether it moves up or down. The key is that we want it to go somewhere. It can't sit still. Now, risk graphs are drawn at a finite period of time, and most of the time they're drawn at expiration. And when you look at this, you say, well, okay, you can make money if it moves up or down, but now it's showing me that, wow, we got to move quite a ways to the upside before we start making money, or we got to move quite a ways to the downside before we start making money. It's not instantaneous. That's true if you're holding the position all the way to expiration, which is not something that we want to do. However, if we put in this nice little U-shaped line, the dotted line called the timeline there, that's showing you today. So that represents right now, today, which means that if the stock begins to move up, you can make money right away. If the stock goes down, you can make money right away. So you don't have to wait for it to move out to those wings of the risk graph to start making money if the stock starts moving sooner. Now remember, one of the keys of what we're going to learn is how to find them early. So here's the key. Getting in, the sooner you get, the closer you are to when the stock moves, the better off you are. And I know I'm talking about straddles, and that's not what we're going to talk about. We're going to talk about strangles, but we have to set the table. If you understand the basics of a straddle, this will help you to understand what we're doing here in a few minutes. So there's your basic straddle. Now here's the key. Here's the Greeks. This is the whole thing that this boils down to, is the math. If we look at delta, delta by definition is the amount an option value will change as a percentage of the stock movement. That's the definition. So let's say we're dealing with a stock trading at 20, and we don't want to go pay $20 a share for the stock. We can go buy an at-the-money call for $2. Now remember, the beauty of options is a leverage. Small amounts of money allow you to control large numbers of shares. So we can go buy an at-the-money call for $2. Rather pay $2 than $20, wouldn't you? Now let's say the stock goes up. We're right on direction. It moves to the upside, $1. The stock moves from 20 to 21. That call option that we bought for $2 is now worth $2.50. So the stock moved up $1, our option moved up 50 cents. So the question is, on that 5% move of the stock moving from 20 to 21, a $1 move in the stock, that's a 5% move in the stock itself. But what percentage did the option go up? Two answers usually come to mind, 25 and 50. The 25% comes from the fact that the option moved from 2 to 250. A 50-cent move in a $2 option is a 25% move in the option itself. But delta is the relationship of the options move to the stock, not the options move within itself. So my point is the option moved up 50 cents, the stock moved up $1. That means that the percentage move on the delta is 50%. Stock moved up $1, option moved up 50 cents, 50% movement in the delta. That's pretty neat, isn't it? Stock moves up $1, and you make 50 cents. We all learn differently. I'm a visual learner, and you can go out there and the auditory learners and everything else, but I need to see it and visualize it. That's the way I learn best. You can go out and find the delta formula, the mathematical formula. I didn't bother putting it on a slide because it's this long mathematical formula. I don't understand it. I went through calculus in college, but I still don't understand the delta mathematical formula, but I can understand this. This is what's known as the delta curve. This is that mathematical formula put in a picture format. The bottom left corner represents a 0 delta. The upper right is a 1 or 100 delta. Now the bottom, if you would visualize, down along the bottom would be that same horizontal line as we had in the risk graph. That's the movement of the underlying, we'll call it a stock because we're usually trading options on stocks, but we can trade them on ETFs or anything else that has options. Now what we just went through with that straddle would be buying an at-the-money call and buying an at-the-money put. So we buy both those options right smack in the middle of the delta curve at the money, which means if the stock begins to move, one of those options is moving in the money, the other option is moving out of the money. So one option is moving up the delta curve, The other option is moving down the delta curve. Now this doesn't represent the stock moving to the upside. It can move to the downside, and one of the options is still moving in the money. So if the stock broke down, the put would be moving in the money, and the call would be moving out of the money. So if we move to the upside, it's the opposite, the call moving in the money, the put moving out of the money. But my point is, if you look at the angle of those two arrows, isn't it pretty similar? In other words, doesn't it look like the option that's moving in the money is moving at about the same speed as the option moving out of the money, which means the one option making money is making money at about the same speed as the other option is losing money. Well, if that's true, where's our net gain? If one's making money at the same speed the other's losing money, how are we making any money out of this? Where's the net? And that's one of the issues with a straddle. Even if you get in early, and even if the stock begins to move pretty quickly, it does still take a little bit of movement out of the underlying before you actually start generating any sort of a decent gain. You know how they say you do your best thinking in the shower? And you know, the funny thing is that I say that to seminars, and I always say that to seminars, and I get the blankest look on from people, and it's maybe I'm the only one that's ever heard that. I don't think so, but I've heard that before. But this is true. I was actually in the shower one day, and if you're not a big options trader yet, if you're just new to this and getting into it, it will get in your blood, and you will be as strange as I am, to the point where you can be in a shower, a place where most people go just to relax, and I'm thinking about trading, and I'm thinking about options, and I'm thinking about the mathematics, and that's where this came to me. If we talk about a regular strangle, okay, so we've been, up to it now, we've been talking about a straddle, buying an at-the-money call and buying an at-the-money put. With a strangle, you go one strike out of the money on the call and one strike out of the money on the put, which means we wouldn't be too far away from that blue line right in the middle of the delta curve, and the two options are equidistant. The beauty of a strangle is you pay less. The complaint that people have, and very few people talk about a traditional strangle. Straddles have their own issues, but even far fewer talk about a traditional strangle. And the view is that now you're asking the stock to move even further. But my thought in the shower that day was, what if we moved the strangle? What if we changed the strikes and moved them to what we call the profit sweet spot on the delta curve? And that's right down here, where that green line is, right in this area where the curve is. Now remember, I asked you to visualize again the horizontal line underneath. That's the movement of the stock. You can see right where that green shadowing oval there is, the curve, the delta curve, goes almost vertical. It's almost straight up. So down along the bottom, if you're visualizing the stock's movement, it doesn't take a lot of movement out of the stock for the delta to accelerate up that curve substantially, moving very quickly. So my thought was, what if we change where we're placing this position? What if we move the options to where we're buying both the call and the put right at that point on the delta curve? And that represents around a 25 to 35 delta, 30 being the actual profit sweet spot. But if you've been trading, you know that when you look at an options chain, you can't always hope to find an option with a 30 delta on the call and an offsetting 30 delta on the put to become delta neutral. So we have to have a little bit of wiggle room here, and that's where that 25 to 35 delta comes in. If you move too far below 25, well, now you're down over here, and you can see the delta curve isn't moving vertically very fast. That means the stock has to move further before you start making money. And if you go too far above 35, well, now you're getting back towards that at the money area, which is the issue that we had with the straddle, where one option is making money at about the same speed the other one's losing money. So that isn't any good. So we need to stay confined into this area around the 30 delta, because now if the stock moves, one of the options is moving up the delta curve at the angle of the green arrow. The other option is moving down the delta curve at the angle of the red arrow. Now when you look at that visually, doesn't it look like one option would be making money much faster than the other option is losing money. The red arrow is moving, it's more horizontal. In other words, it's not losing value as fast. But the other arrow is going straight up. So that one's making money. As that delta goes higher and higher, we're making money faster and faster, where the other one's not losing it as fast. So if one option is making money faster and the other option is losing money slower, in theory, wouldn't this position profit faster than a straddle or a traditional strangle? And at this point in time, again, it's just theory. But I think you would agree, hey, yeah, that makes sense. So now I want to try this, right? I've got to figure this out and give it a try. Let's do a risk graph comparison real quick. There was our straddle risk graph. And then if we add that in with the strangle, there's the strangle. Note we went from a V to a U on the risk graph. And the plus is, well, that horizontal part of the risk graph doesn't drop as far, meaning there's less risk. There's less risk in a strangle because we're not paying as much. We're buying an out-of-the-money call and an out-of-the-money put. It's cheaper than buying an at-the-money call and an at-the-money put. But then the other side of it is the wings are further out. And so the average person is saying, yeah, you're spending less, but now you're making the stock move further before you can start making money. You may have saved yourself some money, but you made it a tougher proposition to generate a profit in the trade. That's the conventional wisdom, but that's not what we're doing. We're taking advantage of the math. We're taking advantage of the delta and gamma. Gamma is the speed of the delta. Gamma is how fast the delta changes. So if the delta determines how much money you're going to make on the very next dollar the stock moves, it's gamma that tells you what the new delta will be after that first dollar move in the stock. So those are the two Greeks that we're taking advantage of as far as getting these to move faster. Here's a trade on Google, example on Google. And if you take a look at this and look in that upper right-hand corner, it's in very small letters, but I'm going to show you something that you'll see before. You'll say 2008. Come on, what have you done for me lately? Why are you showing me something back from 2008? Because this is the first trade that I put real live money in. So I had this thought in the shower, and it was a theory, and I wanted to put it to test. I did back testing. It worked in the back testing, but yeah, everything, all that matters is when we put real money in it, right? So this was the first actual trade that I put real money in. I'll always have this in my presentation because of that. So there's the pattern. We have a beautiful symmetrical triangle. I'll get into the patterns here in a few minutes. We have a series of lower highs and higher lows. Right in the middle there, your candlestick people here, there's a doji, indecision, right? Boy, you got a symmetrical triangle, that's a breakout pattern, and you've got a doji representing indecision right at the point of the triangle. Holy cow, couldn't get much better than this, could it? It really couldn't. I mean, that really is a great setup. So if we were to look at a regular straddle with Google trading at 680, we'd go buy a 680 call and we buy a 680 put. Look how much that's going to cost. $7,045 for one straddle. $7,045. That's insane, isn't it? So most people don't do straddles on Google. If we were to look at our strangle, the Axiom Strangle, look what we did to the cost. We got it down to $2,600 by buying the 750 strike call and the 630 strike put. Now, a couple things come to mind for the average person at this point in time. First of all, okay, well, that's a lot less. I'd much rather pay $2,600 for a position to make money than $7,000. But you're buying the 750 strike call and the 630 strike put. Wait a minute, that doesn't make sense. Google's trading at 680. So the 750 strike call, that's 70 points above where Google's trading, but the 630 put is only 50 points below. So the call is 70 points higher, the put's only 50 points lower. They're not equidistant. It doesn't matter. We don't care. We don't care where the strike is. What is our focus? Our focus is on delta. Delta is the issue. We're going to go down the option chain on the call side until we find the 30 strike call. Then we're going to go down the option chain on the put side until we find the minus 30 strike put. So deltas on a call are represented as a positive number because call options make money as the stock moves higher. So anything that makes money on an upward move of the stock has a positive delta. Anything that makes money on a downward move of the stock has a negative delta. So we go down, where's the positive 30 delta? Boom, 750 strike call. Where's the negative 30 delta? Boom, 630 strike put. Put a positive 30 and a negative 30 delta together, where are we? Net zero or delta neutral. So now we're at a delta neutral position, which that's what we want. We don't want to have a directional bias here. We just want the stock to move and not care what direction. Now the other issue that comes to mind is people laugh. They look at that and they say a 750 call and a 630, that's 120 points apart. Are you crazy? Google can move, but it ain't going to move 120 points for you to start making money. You're ridiculous. Yeah, you're only paying $2,600, but you're going to lose the $2,600 because you're not going to get a 120-point move out of Google. We don't have to. Remember, we just need the stock to move, and you saw that dotted timeline on the straddle. If it moves relatively soon, we make money immediately. We don't have to have it move to where one of the options is in the money. We make money right away, and that's a very important key to remember. So with the Axiom Strangle, we reduced our cost to $2,600 versus $7,000. Well, Google breaks down. It moves down $28 the first day. The straddle generates a profit of $495, and you're thinking, well, that's not bad. But our strangle, the way I've described it, makes, are you ready? $590. That's real dollars on one contract. You paid $7,000 for the straddle to make $495, but we only paid $2,600 for the strangle the way I described it, and we made more. We made $590. You spent less and made more. I don't know about you, but it kind of sounds like a win-win to me. Remember, this is the first one I put real money in. Well, this was kind of eye-opening. The next day, Google drops again. Well, since the stock moved down the first day, which option is in control? Which one is the one generating a gain? Because remember, on the delta curve, one option is moving in the money, one's moving out of the money. Well, if the stock breaks to the downside, it's the put that's moving in the money, and the call is moving out of the money, so it's the put that's making money. So the put was the one that generated the profit that we had after the first day, so we moved down again. We're going to make more money, right? But look at the straddle. What happened? Now we're only up $390. We gave back $105. How did that happen? The stock moved the same direction. Well, there's another little piece to the puzzle known as implied volatility, which I'll cover in a few minutes. Google dropped $28 the first day. It only dropped $8 the second day. Was it as volatile the second day as it was the first day? No. So that implied volatility came out. Look at our strangle. Now we have a $605 profit. We actually made $15. And you're thinking, well, whoopee, making $15. But that's a whole lot better than losing $105, isn't it? Why did the strangle not succumb to the drop in implied volatility? And you may have heard the term volatility crush, and that's exactly what happened here. There's a definition of it, or an illustration of it, I should say. Why didn't the strangle get hurt? Well, the options are so far out of the money, they're not as susceptible to a volatility crush. It still affects them, but not as much. Next day, Google drops again, and the straddle has now generated a profit of $885. Still not bad. But watch the strangle. You ready? $1,090. We only paid $2,600, and we've made $1,090 in profit. We haven't even gotten into money management as far as, well, how much were you willing to put at risk? Maybe we could have done more contracts on the strangle, at least 2, maybe even 3. Then you multiply the profit by 2 or 3 times versus the same amount of money you put at risk in the straddle. Pretty amazing, isn't it? The straddle that we paid $7,045 for generated an $885 profit in 3 days, or a 12.5% return. Again, 12.5% in 3 days, not bad. But the strangle that we only paid $2,600 for generated $1,090 of real profit, a 41.9% return. What would you rather have, a 12% return or a 41% return? Stupid question, I hope. Let's take a look at the benefits. We have less cost and therefore risk. It's a debit position, and in the world of trading options, in a debit trade, whatever the debit is, that's also your risk. You're paying, that's your risk. So we have less cost, less risk, and we make faster profits. And the reason is due to the acceleration of the delta. It's all about changing the position on the delta curve to take advantage of the math. And the math is fixed. It doesn't change. The math is there. That's how the formulas are calculated. So let's talk about the patterns. How do we find these? There are many kinds of breakout patterns. There's wedges or triangles. I like to use the word triangle. We also have pennant patterns, and we have flag patterns. And I know other people will look to flags and pennants for breakouts. I like to stay with the triangles. I only focus on the triangles. In this example here, we have a pattern where the stock moves to the upside, hits a high, comes back down, moves back to the upside again, hits that same high, and moves back down again. So the stock is moving up, running into, what is that called when you hit a ceiling? Resistance, right? We're moving up, we're finding resistance at a particular price level, we're falling back down. We go back up, hit that same resistance, fall down again. But when we're dropping, the lows are getting higher. So we have the same highs, but we have higher lows. And that's known as an ascending wedge or ascending triangle. What direction is that going to move? Most people will tell you an ascending triangle breaks to the upside most often. Well, statistics don't bear that out. The proof is, or the reality is, from the proof, is that it can break to the downside just as much as the upside. Sometimes that resistance holds and the stock breaks to the downside. Sometimes we build up momentum and we force our way through that resistance. We have a big break to the upside. We have the opposite. Now we have a stock that's coming down, finds a particular price level, and bounces up. Falls back down, hits that same price level, bounces again. So now we have a stock that's coming down, finding a price level low and bouncing up. And each time it comes down and hits that same price level low, it's building a what kind of line? Support line. It's building a support line. And then when it bounces up, the highs are getting lower. So we have the same lows, but we have lower highs. And this is what's known as a descending wedge or descending triangle. What direction is that going to break? Most people will tell you the majority of the time this breaks to the downside, that we build enough pressure and we force our way down through the support. Statistics don't bear that out. Statistics say that this can break to the upside just as much as the downside. And then we have my favorite of the three triangles, a symmetrical triangle. This is what we saw with Google. Stock moves up, comes back down, moves up, comes back down. Each time we're playing ping pong back and forth between those two lines, we're setting up a series of lower highs and higher lows. The symmetrical triangle is my favorite of the three. Now, I don't want to make it sound like that's the only one I trade. I don't. I trade ascending triangles and descending triangles. If the pattern is there, I'll trade it. If I had to pick one, if you said, okay, you got three of them, but you can only trade one, you have to pick one. And if I was forced to do that, I would pick the symmetrical triangle. But they all three work, and they work very well. And it's been my experience that they work better on breakouts than flags or pennants. Now remember, all we're asking that stock to do is move. So we're trying to find patterns that generate movements out of the stock. That's the key, hence the triangle patterns. Let's take a look at another example here, PBR, because I know some of you are out there thinking, because I've heard it all, I've been doing this for a long time, and people say, oh yeah, well you showed Google, Google broke to the downside, and we all know stocks move down faster than they move up. That's why you made money. That doesn't account for the deltas and the change and the fact that we paid less and made more, but you get the naysayers, and fine, I've heard it all. Well, I got something for you. Watch this. So here we are with another symmetrical triangle on PBR. And another doji in the middle. Now, you don't have to have a doji at the point of the triangle. It just happened to work out that way. So we're sitting here with the point of the triangle and a doji right in the middle, and we can put on a regular straddle for $2.99. So let's get back down into reality as far as putting $7,000 in a trade like the Google trade. $2.99 to buy the 34 strike call and the 34 strike put. Or we can go buy a traditional strangle, one strike out of the money on either side. And boy, this is one of the things, this strategy has only gotten better over time because now we have more and more securities that have single dollar strikes. When I first started trading, it was at least 5 points between the strikes, and a lot of the times you had 10 points between them. It was far more difficult then to be able to match up the deltas because of how far the strikes were apart. And to get a positive 30 delta call and a negative 30 delta put was very challenging. But it changed rapidly after that, and now we have so many securities with single dollar strikes, it just opened this up to even more potential trade possibilities every single day. So if we put on the traditional strangle, that's $2.11 on the debit, a lot less money. Now if we look at the Axiom Strangle, where we're looking for the 30 delta call and the 30 delta put, that's going a little further out of the money. That's the 36 delta, or excuse me, the 36 strike call and the 32 strike put. $1.42 on the cost. Now notice we've more than cut in half the debit versus putting on the straddle. So we're paying a whole lot less money. Now the stock breaks to the upside because I want to show you it works just as well if the stock moves up versus moving down. None of this, the stock moved, well, we do know that stocks move down faster than they move up. I love it when stocks break to the downside, but it is not a requirement for this position to work and make money. So the stock breaks to the upside, straddle makes a whopping $7. Big deal, but it's profitable, right? The traditional strangle makes $6.50. So you only paid $2.11 or $211 versus paying roughly $300, and you made almost the exact same amount of money. And on our strangle, we only paid $1.42. How much did we make? $7. We made the same amount of profit as the straddle did, paying less than half the amount of money. It's fascinating, isn't it? I'm a little biased, but I think it's fascinating. The next day we move up again. The traditional straddle makes $31. The strangle makes $30. Our strangle makes $27.50. Now you're saying, yeah, you didn't make as much money now, but we paid less than half. You could have done 2 of these for the same amount of money that you put or would have put in the straddle. And now we've made a whole lot more profit if we would have done 2 versus 1. Break to the upside again. The straddle's up $83. The strangle's up $79.50. Our strangle's up $71.50. So not quite the exact same amount of profit, but you have to remember again, we paid $142 versus $299 or $211. We paid a lot less, and we're hanging right in there on the amount of profit. We break to the upside again. Look at that vertical move. We don't have to have a stock break to the downside. The beauty of this is even when we have a situation like we've had in the markets up until recently, where the VIX has been so low, and you're thinking there's no volatility, these aren't moving, this position, these triangles create their own volatility because they break out. When you find these triangle patterns, they're going to break out. Nothing is 100%, nothing happens every time, but almost never do you have one of these triangles where it just kind of goes sideways from it. It's going to make a breakout move, and it's uncanny how much we can predict exactly where it's going to go, and I'm going to show you that in an example here in a minute. So we break to the upside again. The straddle's up $150. The strangle's up $143. Our strangle is up $129.50. So lagging a little bit in the profit, but again, we paid a whole lot less to get in. We move up again. Straddle's up $167. Strangle's up $159.50. Our position's up $145.50. So we're hanging right in there. The straddle would have generated a 55.9% return. That's tough to sneeze at, right? You're thinking, wow, that's not so bad. The strangle, the traditional strangle, would have generated a 75.6% profit. Even better. But the Axiom Strangle, taking advantage of the delta, taking advantage of gamma, taking advantage of the math that's involved in how options work, generated 102% gain. So what would you rather have? 55, 75, or 100? It's your choice. And you know, you hear those expressions a lot, it's your choice, but it really is by which options you select. And by understanding this and picking the options with the 30 delta on both sides, you can pick your position. We have a scan that finds these for us with some indicators and criteria that I put together, one of which to find out as close to the breakout point as we can. We don't like to sit in a position forever and wait for it to break out. So we try to come as close as we can to the breakout point. This is a great example of that other piece of the puzzle that I talked to you about as far as making money on this and what happened in that Google trade. So here we have an ascending triangle, right? And this is on Baidu. So we have an ascending triangle on Baidu. We've got an earnings report on the horizon. Ah, wow, earnings reports. The one thing we're asking the stock to do is move. We got an earnings report on the horizon. We all know earnings reports move stocks, right? So that's all we need, something to move the stock. Well, earnings reports do move stocks, but you got to be careful. Watch what happens here. So we have the position here. We set up our Axiom Strangle by buying the 99 strike call and the 78 strike put, getting that 30 delta call, the 30 delta put. It's going to cost us $7.33 for one contract on the Baidu Strangle. Stock breaks to the upside beautifully. Nice move higher, and our strangle works to perfection. We make $737 on $733 of risk, so that's right at a 100% gain. Beautiful. Our scan identified this opportunity. Now watch what Baidu does. Following that, it consolidates again, this time in a symmetrical triangle right in front of earnings. And now you're thinking, oh my gosh, it couldn't have been any better. We're setting up and we've got another triangle right in front of earnings. We're going to double dip on this one. We're going to get it again. No, our scan didn't identify this opportunity. It didn't show it. Why not? Well, watch what happens, and I'll show you why. $10.40, so $1,000 to get in. Wow, it's higher, right? $7.33 for the first one. This one would have cost $1,040 or $10.40. Why? Why is it more expensive? Well, that's kind of giving you a clue as to what happens here. We break to the upside. In fact, Baidu breaks out more on earnings than it did on the breakout of our ascending triangle. So we break out, we're thinking, great, we made money. Well, no, we didn't make money. What happened? We lost 24%. We lost $251, but the stock broke out, and it broke out more in the price range than it did on the original one. How come we lost money? You have to pay attention to implied volatility. Very important factor in how options are priced and how they make and lose money. Look at the chart of implied volatility down at the bottom. On the entry of the first position, the one that our strangle scan found, because low implied volatility is one of the criteria, look how low the implied volatility was. And then we broke out and the volatility moved up. See how the volatility moved higher? And that's what I was telling you, these triangles make their own volatility. You get a vertical move, even if it's a vertical move to the upside, the volatility is going to rise. We got an earnings report on the horizon. Volatility tends to go up in the options before an earnings report as well, because we all know stocks move on earnings, and so that's factored into the options price. That's why you can't do this. That's why you can't put on a straddle or strangle the day before an earnings report and make money on a stock that moves a lot, like the Baidus, Googles, Netflix, those stocks that all tend to move a lot on earnings. That's just too easy. You can't do it that way. They won't let you, because watch what happens to the volatility. Boom, there's the volatility crush. See how the volatility went straight down? And that doesn't mean that the next day following earnings, I could get out in the morning and still be okay. No, doesn't work that way. that volatility crush happens, and when the options start trading, the volatility is gone. You don't have 15 minutes, 5 minutes, 1 minute, nothing. The options open the next day without the volatility. You suffered a volatility crush. That's why that position lost money. That's why our scan did not identify it, because the volatility was too high. We identified the one where the volatility was low because that is one of our key criteria to getting in. So when we compare the Axiom Strangle to traditional straddles or strangles, again, we have less cost, we have less risk, we generate faster profits. Why? Due to the acceleration of the delta. And I'll get to a few questions here in a minute, but a lot of times the same questions come up. Our scan finds the triangle patterns. I've got an indicator that identifies when stocks are consolidating. So you kind of got to kick out the sideways stocks because it will identify a stock moving dead sideways too. That's not what we want, right? We want one of the triangles that's going to break out. We don't want a sideways stock that's not going to move or continue sideways. We want to get them as early as we can before the breakout. We must have low implied volatility. You just saw that. And we're setting ourselves up for explosive moves. And even when the VIX is low and there's no volatility in the market, the positions create their own volatility. It's just fascinating to me. So again, that's the reason that we've been able to generate this equity curve. Thought I would send out because you can hear me talk about it, but there's nothing like hearing from your subscribers. Like, guys, as a quick note, say as awesome the Google trade was, sold the butterfly. If we have an expensive position, we do butterflies instead of the strangle using the patterns, because even with our out-of-the-money options, then it can be cost prohibitive. But it has to be a high-flying stock. Sold the butterfly for 11%. How crazy is that? I feel like it should be illegal. So just a comment there for you from some of our subscribers. We do have a weekly outlook. You can go to our website and register for the weekly outlook. It's completely free. Every weekend on Sunday, I give a recap of the previous week and what to expect in the coming week. Gives you a little bit of flavor for what we're doing. But what I wanted to show you was one that we just closed. And our web address, by the way, is www.optionaxiom.com. If you have specific questions, you can email questions to support@optionaxiom.com. Let me share with you one that we just finished closing out. It was on Rio. Take a look at this. What kind of pattern is that? You should know this. It's a descending triangle, right? We had a little bit of a breakout, move back in there in the nice descending triangle. Look at those lows around 47. Clear pattern of lower highs. So we did one of our patented strangles here, and boom, look how fast it broke out. Broke out huge to the downside. Now the way you figure out how far it's going to move, because the key is, well, when do I take it off, right? When do I take profits? You measure from the top of the mouth of the triangle, the mouth is the wide part, down to the, in this case, the support line. If it's a symmetrical one, it's the upper trend line and the lower trend line. How far is the difference between the upper line and the lower line price-wise? 75% of the time, these are the numbers. I've done thousands of hours of back testing, so I can give you the percentages. 75% of the time, when the stock breaks out of the pattern, it will break out exactly how far the mouth of the triangle is. It will blow you away. It's uncanny how it hits that level and boom, it's like running into a wall. That's the end of the move. But 90% of the time, this gets a little confusing, but hang in there with me. 90% of the time, the stock will break 80% of the mouth of the triangle. So 75% of the time, however far we are price-wise from the top of that downtrend line to the support line, price-wise, 75% of the time it will move that exact amount. But 90% of the time, it will break 80% of the move. That's what we focus on. You don't get quite as much of the breakout move, but you have a higher percentage of when it's going to hit there. And then the other thing is, when you get a vertical move like this, what do you think happens to volatility? It spikes up. I see a question there. Do you use implied volatility to help you when to get in and out? Absolutely. Great question, Bob. Because when you drop down here and you have this spike in volatility, what does that do? Does a spike in volatility increase or decrease the value of your option? The spike increases it. So now we can sell the puts. With the spike in volatility, we get the profit from the movement and we get the excess volatility. So if you know where it's going to go, it helps you determine when to get out. In this case, it broke so fast and we had January options. We're still in December. We had January options. We sold the puts. We had a 33% gain. Boom, that fast. 33%. The calls had a 10-cent bid. They were almost worthless. But we had all the way till January. So we could have gone ahead and sold them, taken the 10 cents, added that to the profit. It would have been about 37% profit, whatever, moved on. But why not wait? Why not wait and hold that like a lottery ticket? We know nothing goes straight up or straight down, right? So if we get this big move down like this, maybe we'll get a bounce back. So why don't we just hold the calls and see what happens? And you ready? Boom! Look what happened. We just closed out the calls today. Sent out the alert to close the calls out today. We got that rebound back up. The bid went to 30 cents. So that gave us an extra 20 cents of profit. That moved us from a 33% gain to a 43% gain because that 20 cents is all pure profit in the options. Multiply that by the number of contracts that you would have done, and that tells you how much extra money that you would have made. Now, maybe Rio breaks and goes further to the upside. Maybe it doesn't. But you've got extra profit right there. We held it as a lottery ticket for a bounce. It's exactly what happened. Now, we don't do that every time. I don't want to make it sound like we do this every time because one of the dangers of this strategy is people getting greedy and taking one leg off. In other words, when the position begins to break out, it starts to break to the downside and you're like, it's breaking down. I'm taking the calls off. I'm only going to hold the puts. You have to be careful. Here's a horror story. I was doing a seminar. I live in Florida, and I was doing a seminar in Orlando, and a gentleman came up to me, and he was really interested in this because he used to trade straddles, and it was on an old straddle trade where he had done this. It was on a drug company, and he put a straddle on it because this company had a new drug undergoing FDA review, and obviously if the drug's approved, stock's going to rocket higher. So he puts the straddle on 2 days before when they think the announcement's going to come, because I don't think the FDA really alerts you of exactly when they're going to make their announcements. The stock breaks to the upside, so he's thinking, aha, somebody knows something, because we know no information ever leaks out, right? That never happens. Hope you noted the sarcasm there. So he's like, somebody knows something. He takes off his puts and doubles up on his calls, loads up on the calls. He's going to hit a home run on this trade. Well, you can guess what's coming, can't you? What do you think the FDA said? Nope, sorry, not approving the drug. The stock tanked. He wiped out almost his entire account on the one trade because he got greedy. So be careful as far as jumping the gun on taking one leg off. We do it at times once there's a confirmed breakout move, if there's enough premium left in the other option to warrant going ahead and closing it out. If not, why not write it out into a scenario like this where maybe you get a bounce back? And we've done this several times. But again, we don't always do this. They don't always move as fast as we would love for them to do, but perfect example of what just happened. So I thought you might be interested in seeing that. So there's a link on your screen if you're interested in becoming a subscriber with us. You can see that link there. Or what we did was we created an address that you can go to, optionaxiom.com/candlestick forum. It takes you to that exact same link. So if you have any issues writing down the link or clicking on it, or you want to look at it later or whatever, if you can just remember optionaxiom.com/candlestick forum, that will redirect you to this exact same link. And you can become a subscriber at a discounted price because of your affiliation with the Candlestick Forum at a price that we don't offer to the general public. And that's no BS. That's absolutely true. I know I've run late here, and I know that we're here in the holidays, and you'd probably rather get to other things. But let me see if I can answer a couple quick questions here. What is the stock screener to find this pattern? Well, I've got some indicators that I put together, and at this point in time, I haven't really given out the indicators. I mean, I'll give you a hint. I'll tell you that the ADX is a big key on that. because the ADX tells you the strength of a trend, and most people use that to find out if a trend is strong to the upside or the downside. Well, what's the reverse of that? If you have a low reading on the ADX and it's telling you there's no trend, and isn't that what we're doing when we have a consolidation pattern? Because if I gave you all the secrets, right, you wouldn't have any subscribers. Just being honest with you. Let me go back here and see. We have some questions on the math before, and the key is, and this is what people get confused on. Well, if you spent $2,600 and you only sold it back for $800, no, $800 was the profit, and the profit was on the $7,000. We made $1,000 on the strangle. So if we paid $2,600 for it and we made $1,090, we sold it for $3,690. So those numbers were the profit, not the sales price. I was giving you the pure profit, not what we sold it back for. That question comes up a lot. Maybe I need to be a little clearer on that when we go through it. We're showing you what the pure profit was on the position. So obviously to have profit, you had to have sold it back for more than you paid for it. Somebody's saying, I've seen this before, but I didn't get it. Maybe that helps you to get it. Oh, thanks, Jim. I saw that you had already answered that question and helped. Please show a recent example. Okay, you got it. I just showed you one. One that we finished closing out today. That recent? Oh, good question. How far out in time? 46, 45 to 60 days? Somebody's seen this before because that's exactly right. 45 to 60 days is how far out in time we go. And that usually brings up some discussion. Usually people can realize why the 45 days on the low end, thinking that, well, if you go less than 45 days, because 45 days is where time decay really starts to begin in earnest, right? And in the last 30 days, it's very significant, time decay. So we want to try to avoid that. At least if we go 45 days, we got about 2 weeks for it to break out before we get in that last 30 days when time decay becomes very severe, and that's working against us. That's going to hurt us on our profit. So you're thinking, well, then why limit it to 60 days on the upside? Why not go out 120 days? Give it plenty of time to move. Well, remember the keys, what we're doing is the math, the speed of the movement of the delta, which is gamma. And gamma is always higher on nearer term options. So if you go too far out in time, you're shooting yourself in the foot. You're negating everything. You're washing it out. Because if you go too far out in time, the gamma goes down. So you're not going to get the same acceleration in the delta, and you might as well be doing a regular strangle or a straddle at that point in time. So we kind of stay around that 45 to 60 day time frame. Question, I stopped trading straddles because I lost money on the retained position as I was reluctant to sell early and then got caught. I understand. And, you know, as much as I wanted to trade a straddle when I first started trading, thinking, well, gee, all you got to do is have the stock move up or down. You don't have to pick a direction. That's the hard part, right? Figuring out what direction the stock's going to go. But it isn't that easy, is it? And I got dismayed with straddles like everybody else did. And I started looking at strangles because they were cheaper. But it wasn't until I just started thinking of why don't we take advantage of the math, the way options are constructed, the way options are designed to make or lose value. And that's where this came from. And it solves all those problems. Do I offer auto trade? With Option Axiom, I want to be very specific here and clear. We do not recommend brokers. We're not allowed to do that, and we don't do that. But I can tell you that Trade Monster does have auto trade. We do have an auto trade agreement with Trade Monster. So I'm just stating that fact. Again, full disclosure, I'm not recommending Trade Monster as a broker. Simply answering your question. How many recommendations a month do we have? Another great question. Well, we're getting triangles, right? So we need some time for the pattern to set itself up. What you'll find is that they're constant. Now, sometimes we have more than others. We may only have 3 or 4 on at one time, and sometimes we may have 7 or 8 at one time. What we try to do is work off of a assuming, and I try to be realistic too. I don't try to work off everybody having a $100,000 account. I don't think that's realistic. So we try to work off of a model account. And if you have a $5,000 account, we're looking at putting $500 at risk per trade. So those that are in the auto trade, they then adjust the number of contracts that they do. So we send out an alert. I send you out an alert via email or text, whichever your preference is, or both, the instant something's identified. And we're not going to send anything out at 3:45 Eastern time either, realizing that people have to have time to get to their computers. If you don't have time during your day, not everybody can run to their computer when an alert is sent out. Maybe you're trading off your phone if you're mobile savvy, because now all these have platforms that you can put on your phone. Maybe you're not mobile savvy. You don't have a smartphone, or you don't use your smartphone for that. Those types of things. For those of you in that's where maybe auto trade is interesting to you, because they just automatically do it. You just tell them, hey, my account is X size, so if they send an alert based on a $5,000 account and my account's $10,000, do twice as many contracts as they send out on the alert, so that you have the same percentage in each individual position. Just a discussion, something for you to think about. How often are there losers? There's always losers, right? Nothing is 100%. And if you look at that equity curve last year around December, not happening this year. Since October, we have been on an amazing run. Last year, going into the end of the year, the market just stopped. I mean, nothing happened. Even the patterns weren't moving a lot. We had a few losers. You saw the equity curve from the beginning to the end. Now, that was based on a $10,000 model account up to the point. So there are losers. They're few and far between. I think we've had, at this point in time, 9 winners in a row at this point right now. And, does that happen all the time? No, it doesn't happen all the time. Rather than just accept a loss, what I will do is I will roll a position out. And I do that because I am such a believer in these patterns. Now, here's what happens. Sometime, and this goes back to the key of not taking one side off. You can have a stock break to the upside and then have a false breakout, and the big move is actually lower. So if you get suckered in and taken off your puts, then the big move is lower, now you're in trouble, right? Sometimes the stock breaks to the upside, comes down, now it looks like a downside breakout, but then it bounces. There's no such thing as false breakouts on both sides. You can have a false breakout one way or a false breakout the other way, but you don't have a false breakout to the upside and a false breakout to the downside. What that means is the pattern is forming a larger pattern. So sometimes the triangle that we initially traded becomes larger, and it makes a larger triangle. Well, that means we're sitting there for a little while, and that position is starting to realize a loss. Well, we can take the loss and close it out and move on. But why would you want to do that if now you've got a bigger triangle that you know is going to break out even more than what it was going to do before? So why don't we hang around and wait for that? So maybe we have a loss in the original position, we roll it out, but we capture that and we end up making money again in the end. So do we have losers? Yeah, we do. But we don't have that many losers in this strategy. We really don't. They break out. The stocks are going to break out of these patterns. What is the downside of my system? The only downside is nothing happens, that the stock doesn't move. And the beauty of where we are right now, if you take a look at the VIX, volatility is back. Last year in January, volatility came back. We did have a few losers towards the end of last year, not this year, but hadn't happened this year. And this year we've got more volatility going into the end of the year than we had. And my personal opinion is volatility is going to come back in a big way in January. I think January and February are going to be phenomenal months, which makes the timing of this, pretty appropriate. So all we need is things to move. The downside is this: something doesn't move, and it's just so rare. When you see the triangles, they break out. The worst thing that happens for us is they don't break out fast. They don't break out fast enough, and we roll a position out another month. And so you have to wait a little bit longer. You realize a loss in a current position. while we roll it out, and then eventually things move. So that's really honestly about the worst case scenario of what happens. Am I the same person that was on Better Trades? I'm glad you asked that, because it is really odd that there are two Rob Roys that trade options and have gone out and done educational option trading seminars. I am not that Rob Roy. That Rob Roy was originally with Wade Cook, and he was speaking for Better Trades. I spoke for some other educational companies, including Optionetics, was one of the educational companies that I was an independent contractor for. But no, we are two different people. Crazy, isn't it? If you click on the link that's on your screen or in the chat box there, you can see exactly what the pricing is for the subscription. It'll give you all that detail. Are you pricing an implied move based on a straddle and making an assumption that fair value for IV is if IV is less than 16% for 1% implied move, the straddle price? What I'm looking for is implied volatility. One of the criteria that I have is that the implied volatility is in the low 25%, and I will cheat that up a little bit to 30%, but the low 25% of its range over the previous year. So I want, and it really isn't that complicated to see the patterns. I usually just tell people it's like playing connect the dots when you were a kid. Just draw a trend line connecting highs, draw a trend line connecting lows. Do you have an ascending, descending, or symmetrical triangle pattern? Do the deltas match up? And the range of delta is a net 5 to a net negative 5. In other words, if you have a call that's a positive 30 delta and a put that's a negative 25 delta, that's a net 5 delta. And the reason for it being net 5 to net negative 5 is if you get outside of that range, you're actually cheating a little bit to one of the directions. So if you have a positive 10 delta, you're kind of bullish. And the whole idea of this is to be non-directional, non-biased. We don't care what direction it moves. Because what will happen based on Murphy's Law, right? If you have a positive 10 delta on the net between your two options, that stock's going to go down, isn't it? So then it takes you longer to make money to recover that. But I do want the implied volatility to be in the low 25% of its range over the previous year. Has no relationship to the straddle at all. I was just talking about straddles, so you kind of started to get the theme of the fact you can make money whether it breaks up or down. But I also wanted to show you, based on the delta curve, people's complaints with straddles on it takes so long to make a profit when the stock breaks up or down. It has to move a ways. If it doesn't move the next day, I mean, it has to start make a significant move. And yet, because we're taking advantage of the speed of the delta, the gamma, we can spend far less and make money faster. So we spend less and we make money more. Thank you. Put that link back up there for you. Thank you for doing that. Does this work better or worse on options on an ETF versus stocks? I can't give you a blanket answer. In general terms, you think of ETFs as maybe not as volatile as a stock, right? And that's by design, right? The design of an ETF is that you're spreading your risk over a basket of stocks in a particular sector rather than focusing on one individual stock. But I can tell you one of our favorite securities to do this on is GLD, and that's an ETF. That thing consolidates and breaks out, consolidates and breaks out all the time. It works phenomenally well. But there's going to be some other ETFs that don't move a lot, like REITs. I tend to just stay away from those. Even when you have a good pattern in an ETF that's a REIT, real estate investment trust, they tend not to move as fast, and it's boring. And even if you make money, you're making like 10 or 20%. And there's other positions that we can put on that we can put our money at risk and generate a bigger return faster. So it just depends is the answer to your question. However, there are some that work phenomenally well. What happened on the equity drawdown? That's what I was explaining. We went into the end of the year last year, and the market just died. It just stopped moving, and time decay ate up a few positions. And if I can justify a pattern, I'm a technical trader. I've scored 100% on the visual spatial part of an IQ test. I'm not the smartest guy in the world, but visual spatial is when they give you a pattern and you're supposed to say what's the next step for the pattern. Here's the pattern, what's it supposed to do next? So I'm a big technical trader. I love technical analysis. I'm not a big fundamental guy because in the end all fundamentals are averages of what a stock's, the multiple that it's trading based on its historical average. Yeah, how is that so much different than technical analysis? And they make this big deal about it. So I don't spend time on fundamentals. I'd rather look at technicals and what does the stock normally do. So if I can still identify a pattern, I'll stay in the position and let the pattern play itself out. I believe in the patterns. They're going to do their thing. And if it's not doing it as fast as we like, I'm willing to give it time. However, if we get to the point where the patterns just kind of break down, where it breaks out, and it's one of those, 10 to 25% of the time where it doesn't do what it's supposed to do, at some point you have to say, I don't think that is worth staying in this position longer. It broke a little bit. It didn't hit its target. Let's just close that out. And, we had a few of those at the same time, and that's where that little move down is in the equity curve. Doesn't happen very often, you can see by the curve, but it did, and then we immediately rebounded. That was in December when we did that, and we immediately rebounded in January, and had recovered more than what that little drawdown was within a couple weeks. When I lose a trade, do I lose 100% of the premium? There's times when the pattern breaks down. I believe there was one in there that was 100% loser. But that's, the equity curve speaks for itself, really. What has been the worst losing streak experienced by this method? That was it. You see it on the curve. That's the worst losing streak I've ever had. And that was when we had the VIX go down to 10. Market just died going into the end of the year last year. And to be honest with you, I haven't gone back to look at those positions and see that if I had stayed in them, if I hadn't taken the loss but rolled them out and given them more time, with the way January worked, I have a suspicion because the market dropped 7% last January, and there's a good chance that if I'd have rolled them out, that we would have recovered those losses. But at some point in time, you can only go by the information that you have at that point in time. I really believe I'm a very good technical trader, but I don't have a crystal ball, so I'm not right 100% of the time. I don't make the exact move every time. We just did a perfect move on Rio. That one was great. We had a butterfly that we closed out just before the market bounced 2 days ago. It was on a strangle, and we do 2 butterflies instead of the strangle position because we know where it's going to go. So you put a butterfly above, a butterfly below. They're out of the money. They're real cheap, and it moves down and hits that point, generate a 197% return. You can see it on there. On the position, and that went down and hit the lower butterfly, and the upper butterfly just expires worthless. So the cost on average position, again, we try to keep it around $500 per position. That's what we put in there. Well, GLD may not be a basket, but it is an ETF. So, mincing words, I made the comment once that the Federal Reserve prints money. And, okay, no, the Federal Reserve doesn't print money. The Federal Reserve creates the balance sheet transactions which manufacture money out of thin air, but the Treasury prints money. So we're getting into semantics. But the point is, if you can find ETFs. There's some ETFs are more volatile than others. So the strategy works great on some, not on others. Good point by RB, high vol priced into options. Well, remember, one of the criteria is the volatility has to be low for that individual stock historically. So we're not necessarily looking at the VIX. we're not necessarily looking at what's the current implied volatility percentage. We're looking at where is the current implied volatility in relation to the volatility of that stock over the previous year. That's the relationship that we're looking for. If it's too high, I don't care how good the pattern is. If the options are too expensive and the volatility is too high, you can have a stock break out and still lose money, and we don't want to do that. So we'll kick those out. Comment, didn't you say not to do this around earnings? Some people think they should just use it for an earning period. Yeah, I mean, if you get, everybody knows that earnings reports tend to move stocks. And if you put this on right around an earnings report, that volatility is, if you look at a volatility graph, that volatility, that juice is already put into the options. And as soon as that earnings report's announced, the volatility is going to come out, and you're going to get a volatility crush. The same thing that happened with Baidu. The stock moved, but you still lost money because the movement, the money that the Delta made was more than offset by the drop in volatility. So you're not going to be able to do this a day or two before earnings. What we can do is if we can go a couple weeks before earnings, before they start pumping in the extra volatility in the options price, that's ideal. And that's what happened on the one that we identified. Not only did we get the volatility increase from that vertical breakout of Baidu, but we also got the volatility being added in because of the upcoming earnings report. So that was a double whammy in our favor, and hence the fact that it made 100%. The question, I at least haven't seen it yet, usually people ask, what's the average percent return on this? And it's usually in the 30 to 60% range per position. So you saw some that were 100%. That doesn't always happen. Those are rare. What is the winning percentage of this strategy since the time of inception? Since 2008? I'm sorry, I don't have that number. I'm still doing it, so that should tell you something. What do I mean by roll them out? Good question. Okay, so let's say we're in a position and we're in one of those triangles. Stock breaks out. Looks like it's breaking to the upside. Up, coming back down. Now that was a false breakout to the upside. Now we're going down. Oh, no, that one bounced back up. We're building a larger triangle. So this happens. I'm giving you rare instances here. The majority of the time things go as planned. But we get a false break to the upside. Looks like it's going down, bounces back up, we're building a larger triangle. So the position that we had is starting to show a loss. So we get down to where we've got around a 50% loss, we'll sell that one out, close that one, take what premium's there, and then buy another month out in time so that we give it more time for it to break out. It's building a larger triangle. It's still going to break out. It's likely to break out even more at that point in time when it moves. So we give it more time, and when it does break out, the profit that's generated once it breaks out recovers the loss from the original position, and it recovers the premium that we put in for the new one. Those are going to be your 20 to 30% gains because we have more money than we put into those, and it took a little bit longer to move. So we still get the loss back and make a little profit, but it isn't going to be like a 60% gain. Yeah, the equity curve is based on approximately 10%. $5,000 account, $500 per position. Average time I hold a position, the average time is we put them on 45 to 60 days. The indicators that we use, I mean, we've had them break out the next day. I don't want to lead you to believe that that happens all the time because it doesn't. It's fun when it does. They answer your questions about 2 weeks. I have used other commodity ETFs. I've used currency ETFs as well. Weekly options covered in the course. We don't get into weeklies on this basic subscription. There are other subscriptions available that we'll get into using weekly options. Weekly options are, they're kind of a little different animal. You're asking something to move rather quickly. There are situations where this works really well in those, and kind of keep this a bit more basic so that there's something for even people that aren't or don't consider themselves to be very savvy as far as trading options. Something that the average person can come in and make some money with. But we do have some things that are a little bit more complicated, designed for those that have a bit more knowledge in the world of options. But to answer your question, not on this one. Can I help you improve your golf game? I promise you I can help you improve your golf game. I love teaching people how to play golf. Now, I'm not saying how much I can help you improve, but I can help you get better. Go out on the golf course and find out. How did I determine the sweet spot is 30%? I didn't determine that. That's the math. That's where, if you look at the mathematical relationship of where the delta is on that curve, that's a depiction of how the math is designed on the delta curve. I didn't draw that curve. That curve is a mathematical depiction of the delta formula. So when whoever they are created delta and how the relationship's going to be, all that is a visual depiction of the mathematical formula. And it's just a fact that the 30 delta is right at the point of the curve where it begins to go vertical. So my only thought was, well, why don't we just take advantage of that? If that's a fact, if that's how it works, why don't we buy the call and buy the put right there? Nice presentation, worth the wait. Thank you. Apologize again for the late start. And I don't know why the QuickTime didn't want to cooperate with my computer. I was really trying hard. So I had to do a lot of manual clicking there that's normally automatic. But thank you for the comment. I do apologize again for waiting. Question, is it correct that the most one can lose on a position is what is initially paid? Absolutely. You can never lose more than what you paid. It's a debit position. It's a fixed risk position. You can never lose more than what you put in. And obviously we don't want you to lose that. We want you to make money rather quickly and move on. And this has been a fantastic year. We've had some volatility, and it's been a lot of fun. It's fun when they break out and move like that. It's absolute blast. Let me show you the Google one. See that? There was the triangle. That's when we got in Google. That one moved. Here's a current one. Broke out today. See that? KSS, see the triangle? Some of you want to see more recent examples. There you go. $1.81 moved today on a $58 stock. Where are those? We do have a manual and a DVD. Be happy to send one to you if you like. This is recorded. You can go back and watch this. The DVD is just the same exact presentation. So, do I ever sell strangles? I tend not to. I like to stay on the fixed risk side of things. I know sometimes you might think, well, you know, if the volatility is sky high, well, we just do the reverse. But I want to stay on the fixed risk side of things. I had my foray into selling naked options and made a ton of money, lost a ton of money, and I like this better. Now there's a really good question on an ETF, the VXX, and obviously you know something about options because I used to trade the VIX, and I'm sorry, I'm going to wrap this up. I'm so late. I apologize for keeping you as we're moving into the holidays, but I could talk about this stuff all night. I made a ton of money trading the VIX back in 1999 and 2000. It was like clockwork. It would move between 20 and 35. It was the firmest trading range you've ever seen. You go down to 20, and you know, market's getting ready to sell off. The VIX is going to go up. The VIX would go up and hit 35. The market's going to rally, and it was so much fun. It was actually really easy to trade and make money. Then they changed the formula for the VIX, right? And then they changed it to the S&P 500, and you know, more time incorporated in it. They changed the entire formula, and to be honest, I haven't figured out a way. I've tried. I haven't figured out a way to make consistent money on the VIX since then. But the VXX is a different story, and the VXX tends to work a lot better. So that's a great way to trade it. Outstanding question. Is there a contact number on our website? There's a phone number that if you want to call into support, or you can simply email us at support@optionaxiom.com if you'd like to talk more. Yeah, Jim's reminding you, you only do this when there's a triangle pattern. That is extremely important. This is not for every stock at every point in time, because if you do that, you're going to have a bunch of losers. You need something that's going to make the stock move, and we just talked about the perils of doing it with an earnings report because you're going to get the volatility crash. So what is it? It's these patterns. It's the triangle, an ascending, descending, or symmetrical triangle. You cannot do this on just any old helter-skelter stock trying to take advantage of those deltas. You need something that's going to trigger the movement, just as what you see on your screen. So I'm going to let you go. Thank you so much. Appreciate the questions. Fantastic questions. Thanks again for hanging in there with me with the late start. Hope you enjoy this. My appreciation to Steve and Candlestick Forum. My condolences to Steve and his family on his loss. And thank you so much for your attention this evening. Hopefully they'll have me back, and I'll talk to you again another time. Wish everybody a very happy holiday season. Yeah, KSS is a great example. It's on your screen right now. We're in this one, and it just broke out today. Very happy holidays, everybody. Thank you so much. Appreciate it.